This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Stop maxing out your pre-tax retirement account. Why this unpopular financial planning advice may be exactly the advice that you need to hear today. Welcome to the Wise Investor Show podcast. I'm Matt Anderson, financial planner with the Wise Investor Group of Raymond James. Our heavy hitters, Simon and Chase, are out this week, so I'm stepping up to the plate with a planning-oriented show. Now, before we get started, a very quick disclaimer. I'm going to cover some tax topics in this show. I'm not an accountant, so this information is meant to be for general financial planning purposes only. It's not tax advice. Please consult your tax advisor to discuss any of the information that I cover in today's podcast. So with that out of the way, let me begin this show by painting a picture for you. Bill and Jane are 55 years old, married with kids, have a household income of $250,000. They're good savers. They've been maxing out their company retirement accounts for years. They've made wise investment choices, and they've built up $2 million in their company retirement accounts. Along with the retirement accounts, they have $50,000 in savings at their local bank. Bill and Jane's last child is finishing college, and their home mortgage is almost paid off. Bill doesn't hate his job, but there are a lot of other things he and his wife would like to do. Bill and Jane figure they'll need about $100,000 of after-tax income to live comfortably in retirement. With the addition of Social Security, they think they're in pretty good shape, and they set up an appointment with a financial planner to determine whether they can retire in the next few years. Unfortunately, they're disappointed to learn they aren't in as good of shape as they thought. You know, this is a situation that I see a lot in my practice. Unfortunately, I have to be the bearer of bad news. Good savers, plenty of assets, but no account diversification. Now, I don't mean asset diversification, like how much is invested in stocks, bonds, or cash. I mean that all of their money is in tax-deferred retirement accounts. So what's wrong with that? I'll get into a number of specifics, but the main problem is lack of flexibility. By having to rely on their tax-deferred retirement accounts for income, they have no control over their taxable income. The distributions will be 100% taxable, assuming all contributions were made before tax, and cause them to forego many additional planning opportunities. Before getting into those missed planning opportunities, what's the solution for this couple? Well, it's simple. Start building up an after-tax pool of money. But after they make their 401k contributions, there isn't any money left to fund an after-tax account. Okay, then stop maxing out their retirement contributions. Gasp! I can hear the pundits already. Yes, I said stop maxing out 401k contributions. Now, let me be clear. You should always contribute enough to receive 100% of the company match. That's a 100% return on your money. But beyond that, the remaining amount of your savings should go to an after-tax brokerage account. You can also consider contributing to a Roth 401k, but be aware you will need to have the account open for 5 years before earnings are not subject to taxation. Also, the main benefit of the Roth is the long-term compounding of earnings. If the time horizon for the Roth 401k is short and you're going to exhaust the account in a short period of time, the after-tax brokerage account is the better choice, in my opinion. However, the main idea is to get money into an environment where access to the funds will not cause a significant increase in taxable income. Now, what about money that's going towards other financial objectives, such as, say, paying off the home mortgage before retirement? Yes, this also means that you might have to forego paying extra on your mortgage. If you're using discretionary dollars to be mortgage-free at the expense of building after-tax savings, you should consider whether this is the best use of your money. I'm not even going to get into whether you should be paying extra towards principal on a mortgage at 3% or less mortgage rates. That's for a completely different discussion. Now, we've been talking about a couple who only has so much money to save. If you're high income earners and you have the ability to max out your pre-tax retirement accounts and also save into an after-tax brokerage account, then I'd certainly do that. In addition, maxing out pre-tax retirement accounts for high income earners is usually recommended because most people are not going to be in the 37% plus tax bracket in retirement. So let's get into why the flexibility of an after-tax account is so important in retirement. Number one, if you're considering early retirement, it's not just important, but it's essential. If you want to retire before age 59 and a half, you're going to have to contend with the 10% early withdrawal penalty for pre-59 and a half withdrawals from tax-deferred accounts. For a couple who required $100,000 of after-tax income, that may mean distributions of $130,000 or more in order to cover the taxes and the penalty. Yes, there are ways to access the money before age 59 and a half without being assessed the 10% penalty through something called substantially equal payments. However, the calculation is cumbersome, and the ability to access additional money over and above the fixed payment would be disastrous and result in a retroactive application of the 10% penalty. Second, how about health care before age 65? Now, this is one of the biggest and most overlooked issues in retiring early. How are you going to get and pay for your health insurance before you're Medicare eligible? If you don't have access to retiree health care through your employer, and I'm not referring to COBRA here, then you're going to have to get private health insurance or go through the ACA marketplace. ACA marketplace, another name for that is Obamacare. Now, costs for private health insurance can run over $2,000 a month. This is likely much higher than you were paying through your employer. Many people opt for Obamacare instead. Now, here is where the after-tax account is crucial. Obamacare premiums are based on income. The premium assistance available is sizable and can be over $1,000 a month or more. If your only income is derived from your tax-deferred retirement accounts, your taxable income is going to be high. Let's look at an example by using the Virginia ACH marketplace website. A 60-year-old couple with income of $130,000, so this would be the couple that we were talking about who has all their money in tax-deferred accounts and needs to pull out $130,000 to fund $100,000 after-tax retirement, who lives in Loudoun County, Virginia. That's where I live, so we'll use that. They will be looking at paying premiums of $921 a month. Now, there's some different plans in the ACA marketplace, silver, gold, platinum, but this assumes kind of an average amount that someone would pay. However, if this couple had money in an after-tax account, they wouldn't need to distribute money from their tax-deferred accounts. Therefore, let's say they have income of only $30,000. They don't pay taxes on the $100,000 that they're pulling out of their after-tax account. They only have to pay taxes on the portfolio income. And much of that income will be taxed at 0%. We'll get into this a little bit later. At $30,000 of income, their premiums will be $2 a month. That's a premium savings of $919 a month. It's a huge benefit that many people are overlooking. Next thing that we're going to look at is changes in federal income tax rates. Now, the advice for maxing out pre-tax retirement accounts is often based on the assumption that tax rates in retirement will be lower than they are while you're working. Therefore, defer the income now at higher rates and distribute the income in the future at lower rates. But is this a safe assumption? As I stated earlier, for high-income earners deferring income taxed in the 37% bracket, this is probably a safe assumption. It's not 100% guaranteed, but it's safe. However, if you are deferring income that would be taxed in the 24% bracket or less, and that's less than $383,900 of taxable income for joint filers and less than $364,200 for single filers, this may not be a safe assumption. Now let's go back in a little bit in time and let's look at what the tax brackets were. For all of the 1990s up through 2001, the lowest tax bracket was 15%. We now have 10% and 12% tax brackets. In 2001, the second lowest tax bracket was 27.5%. The 27.5% tax bracket for married couples began at $45,200 of taxable income. If we look at that in inflation adjusted, that's equivalent to about $79,759 today. Do you know what marginal tax brackets for $79,759 are today? It's 12%, a 15.5% difference in tax rates. In fact, you don't hit marginal tax rates above 27.5% nowadays until you're at the 32% tax bracket, which begins at $383,900 of taxable income for joint filers. That's over $300,000 more income you need today to be paying similar tax rates as you were paying back in 2001. Now I ask you, with the skyrocketing debt we have today, do you think it's unheard of that we might have to see higher tax rates in the future? Would 2001 tax rates be out of the question? I don't. And if you're thinking this will all be taken care of by taxing the rich, I'd ask you to think again. Looking at it this way, these might be the lowest tax rates now that we'll ever see. If all of your income, besides Social Security, is going to come from IRA accounts, you're at the mercy of the government when it comes to taxes. If tax rates go up, there is absolutely nothing you can do about it. You're going to need that money to fund your retirement lifestyle. The planning opportunities are now. They're not in the future. If you have money in after-tax accounts or in tax-free Roth accounts, you have more control. Yes, you'll still be subject to RMDs, required minimum distributions, at 75, but most likely at a much lower amount. And currently, you have the option to do qualified charitable distributions directly from those tax-deferred accounts that may help to decrease the tax impact of some of those RMDs. So we're going to take a little break here, and we'll be right back to finish up the second half of the show.
The political temperature is only going to get hotter. It doesn't mean you need to lose your cool and make emotional decisions. I'm Simon Hamilton, Managing Director and Portfolio Manager with the Wise Investor Group of Raymond James. Every week we discuss the latest financial trends and what investors need to know. To help filter out the noise distracting you from sound portfolio management and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show podcast. Let's get back to some of the planning opportunities that we have available to us when we have money that we've built up in an after-tax account. So 0% capital gains tax rates. Let's talk about that a little bit. Besides higher federal tax rates, by having all of your money in tax-deferred accounts, you're also missing out on the benefit of the 0% capital gains tax rate. Currently, long-term capital gains and qualified dividends that fall below $94,050 of taxable income for joint filers and $47,025 for single filers are taxed at 0%. As an example, you could have $1 million saved in an after-tax account that, let's say, generates $25,000 of taxable interest, $15,000 of dividends, and $15,000 of long-term capital gains, and only have to pay tax on the $30,000 of interest income. Oh, but wait a second. Your standard deduction or your itemized deductions will wipe out all that taxable interest, and the dividends and capital gains will be taxed at 0%. The additional money you need for retirement will just be a return of principal, and it won't be taxed at all. So you can potentially be financing a $100,000 a year retirement with absolutely no tax. Pretty nice. Now let's talk about Roth conversion opportunities. Another opportunity that an after-tax account affords you is the ability to take advantage of Roth conversions. Because we just said you will be able to fund a $100,000 retirement with potentially $0 of tax, that means there's a huge opportunity to move some of that money that you did defer into pre-tax retirement accounts into a tax-free Roth IRA account. Money that you convert from a traditional IRA to a Roth IRA will be included as taxable income, but it will be taxed at very low income tax rates. Let's use our prior assumption of a couple who has $30,000 of taxable interest, $15,000 of dividends, and $15,000 of capital gain. This couple could make a $60,000 Roth conversion with $23,200 taxed at 10%, and the remaining $36,800 of it taxed at 12%, and still have virtually all of the $15,000 of dividends and $15,000 of capital gains taxed at 0%. That is a win, in my opinion. And a client who retires early could do this for many, many years, either until Social Security begins or even a smaller amount after that until required minimum distributions begin. Now, be aware the additional income from the conversion will affect those Medicare premiums we talked about earlier, so you have to add in those lost premium savings in determining your tax pain threshold. Speaking of tax pain threshold, many people may decide that even a 22% or 24% tax rate on the conversion is tolerable, especially if they have a sizable IRA account and required minimum distributions plus Social Security will push that rate up later in retirement. You also have to consider the rate beneficiaries may pay in having to distribute the inherited IRA over 10 years. Lastly, having after-tax savings may allow you more flexibility in when you decide to begin Social Security. Many people feel delaying Social Security until age 70 is a good plan. The 8% annual compounding on the benefit beyond full retirement age can be attractive. However, if you have to pull money out of your IRAs to fund your retirement, it may be wise to begin Social Security at full retirement age instead, especially if the tax on the distributions is pushing the IRA withdrawal rate up to an unsafe level. The taxes, along with the combination of, let's say, a poor investment market, may also make the decision to delay Social Security unwise. Having money in an after-tax account, and maybe even having some cash reserves outside of those tax-deferred accounts, may make the decision to delay more attractive. So to put a bow on this show, maxing out your pre-tax retirement accounts is not always the right advice. Having money in Roth accounts and after-tax accounts is important in providing tax diversification and supplying you with the most planning flexibility and options in retirement. That's it for our show today. I hope that you found this information useful. If you did have any questions for your own retirement planning or financial planning, we're always available here at the Wise Investor Group to help you out. Thank you very much. Have a great one.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.